Any questions or concerns?
No, I'll make a motion to approve.
Okay, we have a motion to approve. Do we have a second?
I'll second that.
Okay, we have a motion and a second. All those in favor say aye.
Aye.
Aye. Motion passes 6-0. Okay. All right, follow-up items from our last meeting. The only one I know about was the movement of the fund, the Dodge, Cox Fund, and I think that's in process. Okay, so I think we've done our part here, even though it took a few weeks with the holidays. It got delayed a bit, but that's been done on our part. And then I don't know if there's anything else significant. Anything you have on Solta's side follow-up that we need to talk about first?
The last meeting, no.
Okay.
Did you guys do your training with new member?
Oh, no, I don't think we shared yet. Oh, we have not.
Okay.
No.
I just noticed that was on the action. I didn't know if they'd followed up with you, Jeremy, yet or not.
I just assumed they didn't like me.
Yeah, that
They can't. Like me,
That's
they haven't
a-
met me yet. Then must-
That's not the right assumption.
just so everyone knows, we will be going into closed session after our regular meeting to talk about benefits with our broker and some issues, questions that are surrounding that. So just wanted to prepare you guys for that, for the meeting after the meeting. So yes. Okay, let's turn it over to Soltis and let's get the updates.
Perfect. Thank you, Ralph and committee. We are glad to be here in person. It has been a while to have everybody in the room, and always glad to be here. I'll just go through the agenda real quick, as we usually do, and make sure there's not anything that we're missing on that agenda. I'll do my best to. I know there's a packet, and then we'll have it up on screen there as well. But we'll take just a few minutes here on a quick summary. I think we just had our first quarter fiduciary webinar or fiduciary training on the Secure Act 2.0. I know that as we always kind of state in here, your plan is not governed by ERISA. So Secure Act 2.0 is regulation that's been passed for plans that are, but I think there's definitely impact that for this committee to consider with the number of changes that law brings. That's a big piece of legislation. One of the largest we've seen in probably the last 15 years. So there's really a lot in there. On the 9th, we did a training with our ERISA attorney, Fred Reish. He really kind of went through and just outlined for existing plans like Utah County what that kind of means. And we'll take some highlights on that today as we go through it. We did record it, so for those that weren't able to attend it, we'll have that recording ready here in the next week, and we'll send that link out. We'll touch base on we have our annual fiduciary training conference coming up on April 27th and 28th. We'll touch on that. We also have a quick update, on from the Department of Labor. They've made some changes around what's called ESG criteria, environmental, social, and governance criteria for plan sponsors to consider as they look at investments in their plan. So we'll touch on that briefly, and then of course provide a review of the investments and of the, I'll go to the other side of the page. We'll turn the time over to Voya and Bishop, have him go through the kind of the report that we've had Voya prepare and condense a little bit, kind of the executive report on plan demographics and metrics. And then of course a review of the ease or the account that's managed there for the plan expenses. And then we'll of course provide the review of the investments and the education that's been conducted in the past year, as well as what we have on the docket for this year, and then wrap up from there. So as usual, there's lots on that agenda, but is there anything that's not on here that we're missing or we need to add? Okay.
No.
With that, I'm going to turn it over to Tucker and let him just kind of go through a quick report of last year as we look at page 9 in the packet, which is the business calendar, and kind of lines out all of the items that we go through on an annual basis, and just report on 2022 as kind of a recap for all that was completed in 2022.
Yeah. It was a busy year, as the team is aware. Whenever your plan goes through conversion, So I'm sure we're happy to be finished with that, and now we're kind of off and running with Voya. We're excited to see that for a lot of reasons. One, we think that Voya overall is still an enhancement to the participants, and we're glad to be moving forward with that. Along with
Can
just
I ask a
reviewing-
question real quick?
Yeah.
Sorry, it's Rob. Hindsight now, was that a poor year to go through a conversion because of the market conditions? What would your response to that be?
Yeah. So in terms of a transition, if it goes smoothly, it really, I mean, we do things in kind, so your participants aren't really out of the market, so you don't have that issue. So whether, in other words, their experience in the market, the investment lineup was basically maintained, so they have the same investments. So from an investment standpoint, you know, the timing of 2022 didn't have a negative or a positive impact, I would say, in that regard. I will say this on the managed account front, that went from Goalmaker to the managed accounts. I think there's some benefits there in that one, obviously the fees went down, so the participants in that were in Goalmaker, you know, there's a pretty sizable reduction that they received in fees. The second thing I would say about managed accounts is it does a better job of looking at a participant's overall picture, and in cases where your participants have more assets, it actually will make their portfolio a little more conservative. And so I know Tucker can speak to this in the team, but I know in a number of cases, participants looked and said, oh, my portfolio is a little bit more conservative than it was. And it's because there's more data on them. And so in that regard, that would have been beneficial for sure in 2022 as the markets declined in doing that. But Tucker, is there anything you'd want to add to that?
Maybe just to echo, yeah. I know a lot of questions have come across about Goalmaker, and maybe as far as the transition goes, in the future, I think one thing we'll pivot towards is continuing to offer more open and accessible education, because a lot of people had questions about why their accounts were allocated a certain way, but overall, we think, you know, with additional information, they're more in a more appropriate allocation. And so I think maybe that's the thing to take away. Not necessarily that the conversion was a good time to do it, but we think it was a good time for the sake of Goalmaker because it got people allocated correctly in a volatile market.
Okay, thank you.
Kind of in that same vein, it's always good, and we know we emphasize this, but every 2 to 3 years, we think it's a good idea to benchmark the plan. So having gone through that, we know that the plan's current, I'd say, with competitive market pricing, and so we're excited about that. A lot of changes as far as legislation goes, and we'll continue to see more with Secure Act 2.0, but we know that we covered a lot with the CARES Act last year, and now we're just moving now into the Secure Act, and we'll cover more on that. Overall, the plan investments continue to perform what we think is at a high level, beating their benchmark and giving access returns that are pretty significant, we think, to the plan participants. And so we're happy to see that if you look at the investment reviews each quarter, you know, we had a few funds come on watch in the second quarter. And then if you look at the calendar for 2023, we're back to one fund on watch. And so and we're going to recommend a replacement for that one. But we continue to see a high amount of investment beating their benchmarks by above 1%. And we're excited about that. And maybe just a few things to wrap up the business calendar. We're excited to see the progress we've seen as far as the education efforts have gone towards the plan. We kind of gave a summary of 2021 last year. You see in that bottom right corner in the 2022 calendar. In 2021, we met with 135 participants. So seeing the demand, we brought an additional advisor. And in 2022, we were able to bump the individual meetings up to about 230 that we covered last year. So we're really excited to see about a 70+% increase in participation there. We know this number might be a little bit skewed just because Voya and Prudential might be looking at these numbers differently, but overall we have a very high participation in the 401k plan. You can see right there the number as of this last report for the 401k, since we know that the main account a lot of people participate in, it's got the got 99.3% participation rate, which we think is pretty significant, a pretty good sign there. And then, like I said, we have that 70.4% increase in individual meetings. From our last meeting, we talked about how can we touch more with the law enforcement and the agencies outside of just this main hub area, and we're going to continue to do so by choosing different dates that we can come up and be available, and then just opening up our schedules overall. So we're excited for this next year. We know that the effects of COVID are kind of winding down, and we're able to get to be here more in person. Some of those efforts, on top of our quarterly webinars, will be more focused retirement readiness webinars or seminars that we'll hold in person up here in the valley. And we know we kind of do one each year for Utah County that specifically focuses on the Social Security and Medicare that would affect the employees in particular. And then maybe just to summarize that, going into 2023, we know some big changes are going to come up. We see on the results performance side, on the right-hand side, we think there are some good things that are going to happen in the plan. We'll cover that with Secure Act 2.0. We'll talk about in the investment review, we think there's additional improvements that can be made to the fund lineup with the target date funds, which take a pretty significant amount of assets. And as always, our education goal will be to have 2 advisors on site available. And as the demand increases, we'll be flexible as well to be able to meet that demand. So, any questions or comments from those in attendance or committee members?
I will say we appreciate your participation in the fiduciary trainings. This committee's been well represented, and we have it in the documentation file that you attended and those type of things. So, including the one that we did with the entire committee earlier in the year, just as a refresher. So I think we continue to see more. Again, you guys are exempt, but from plans that we work with around ERISA, we see that the training element continue to be more of a focal point for auditors in the Department of Labor. So we'll continue to hold it as like we do, and appreciate the committee's involvement there. Any questions? I know there's a lot on those two calendars, and 2022 was a big year. Rob, your question was a good one. There's probably, Brandon can probably, I don't want to speak for you, Brandon, there's probably never a great time to go through a conversion. But I think for the most part, as we anticipated, most of it went pretty smoothly. We always anticipate a few hiccups here and there. I think we've got the percentage item in terms of deferrals fixed. But for other than that, I think I would say the committee, looking back on that, is there anything that's unresolved or anything of issue that still needs to be kind of discussed around that transition with Voya?
Are you aware of anything, Ralph?
No.
Okay. I know when we did this, we had some initial hiccups with some folks and I think those got all resolved as far as I know. We talked about that last time, so I think it wasn't a lot of hiccups, just a couple here and there.
Yeah, which is
Which
pretty,
happens.
yeah, pretty par for the course. And I think Tucker pointed out, I think with the transition, one thing that's always good, the level of engagement that we have with participants has increased pretty dramatically. It's one of the things that a conversion does. It helps kind of spur some conversation, and I would say I think the conversations we had with your employees was definitely very positive in terms of continuing to communicate with them of, hey, this benefit, continue to look at it and make it better. I think those particular in Goalmaker, as we went through that, I know it's a little bit different. So when they see a new experience, we always anticipate a little bit of, hey, this isn't the same as it used to be. But I think as we took time with those participants to kind of go through the benefits, the enhancements that they have, the reduction in cost, I think we felt like the overwhelmingly the message was, hey, this is a nice enhancement, a nice solution for us. So anything you would want to add there? You were more, Tucker and team was very close to it. So
No, I just keep saying them if people get frustrated, kind of navigating the Voya website and the Morningstar website. So just continue to push them over to us if they got questions.
okay, let's go to keep my agenda here on this page so I can keep track where I'm going. We'll talk on, as I mentioned, the Secure Act 2.0 training that we did last week. Again, we'll have a recording of that shortly. We will plan to follow up. For those of you that were on that training last week, what Fred outlined is there's about 80% of provisions in the law that are optional. and then about 20% that are mandatory. And what that means is we anticipate that in the next couple of quarters that we'll want to have a conversation with this committee, kind of going through each of those, to help you determine which of those provisions you may want to put in to your plan, which ones you may not. Things like student loan, match, emergency savings, etc. So we're working right now to kind of boil down all of those, and then we'll plan to, in either the next meeting or the following, the second or third quarter meeting, be able to kind of take the time with either committee, and maybe this is a question, Ralph, for you and the committee, is if this is the appropriate place to do that here, or if we want to do that in preparation to the formal committee meeting, of kind of going through those.
So I think if the members of, the committee have a chance, to view this, I don't think we'll need to have a meeting before the meeting.
Okay.
So as long as we can hopefully all, view the training, we have what it's about, then I think it would be fine to do in the second or third, quarter of this year.
Okay.
Do you know when this, has to be done by, these changes? Is it by the end of this year?
So it varies. Each
Okay.
provision, some of them are a little different.
Okay.
The reason we want to probably do it this year is I think you'll want to make decisions on those. There's quite a few that you can make effective or go into effect next year of 2024. There's some that go into effect by the end of 2025. There's some that go into effect all the way up to 2027. But I think for the most part, most plans will want to have the discussion, make those decisions so that going into next year, you kind of know what provisions you do want in your plan and what you don't. And like I said, the large majority of it is option. So, these are features that you can't do today that you'll have the option to consider and say, yeah, we do want to put this in our plan now. And then there's some that are mandatory that we'll go through as well. And, the mandatory ones are basically most of those timing wise have to go into effect by the end of 2025. So there's a little more time there in doing that. And then maybe the last comment I would make is the way that I'm probably telling you something you already know. From legislation, when it passes, we'll kind of implement. You guys will determine what to do, and then the amendment for the plan actually doesn't have to be done for a couple of years. So we can figure out which one of these you want to put in, and then the actual formal amendment to the plan will take place. Again, it has to be in place, I think, for most of those by the end of 2025.
Is there any issues from Voya as far as what they've got to do? Because a lot of stress and pressures on those guys to change all of their programs and so forth to accommodate this new act.
They definitely have the biggest lift. I'll let Bishop respond, but that's usually when this legislation passed. The reason that it's delayed is because they've got to give the providers times to build their systems to accommodate.
Yep. Yeah, I mean, exactly. Right. And we have multiple work streams going on right now on not just the items that are effective this year, but in coming years. So there'll be, I think, like a continuing dialogue within the company, also with our clients as we move through this year to determine what's going to impact next year. Most of the items for this year are already covered, or are items that are easily covered from a systems or operational standpoint. Probably the biggest one that's not is the optional idea of self-certification of a hardship withdrawal. Those are things that we're looking at and trying to determine what the best path is. But I would guess it'll probably be something similar to the optional, or I shouldn't say self-certification for CARES Act withdrawals that took place. So kind of a form with a checkbox and a reminder that they need to keep certain information on hand in case they're audited, that type of thing. But for the most part, this is going to keep going, on through the summer for us, as we roll out through each of these items.
So I do have a question, if that's okay. As it relates to 2023, is the only thing that's effective now that will apply to county employees, would that be RMDs potentially?
I believe so.
And
There's RMDs and then part-time
okay.
employees.
So my follow-up to that question is, has any communication, this might be better for Ralph or Brandon, any communication gone out to employees related to these changes, just to notify them of the changes, and maybe Soltis can help craft some of that information to employees, let them know that these are the changes that will have an effect. Any thoughts on that?
Yeah, I think as soon as we've made the decision of what we want to do or what we have the choice in to do, that I think that's the time to essentially make those communications. And I'm
The RMD is required, so it's not. That's an automatic.
so.
my
So, do you
understanding.
think we should wait until we know what we're going to select along with the mandatory items, or should we send out the mandatory items now?
I think you candidly probably want to wait, because even on those mandatory like the RMD, it won't, like, as you read through the provision, depending on their birth date, like for those that are going to get it, would qualify this year, they're going to still have it. It kind of begins to get pushed for those at a later birth date. So, I mean, it's kind of a preference. I think
Okay.
you're going to want to communicate, hey, these are going to be the changes coming in our plan. And the question is, do you want to do that multiple times, or do you want to do it all at once? When you kind of have those in summary, because I think you'll have plenty of time. If we have this discussion in the second or third quarter, between now and the end of the year, you can communicate those out and do that. Or we can pull them together and you can begin to communicate as quickly as you want.
And I'll leave it at Ralph's discretion, but I do think that it's a small population that's really affected by the RMDs right now. I mean, a very small population of the county employees. But sometimes when you send an email out that reflects 4 or 5 changes, that causes more confusion than one that sends one change. And so that's my take on how. Plus, most employees that are like me don't read all that long emails that get sent out. I get to the first 10 seconds and I'm about done. So I'm just wondering if there's things that are mandatory upon us now without the discretionary part, but just the mandatory requirements, then why not get those out? At least let the employees know. Then we can kind of check the box on those and move on to the next ones. But
If I can just add one thing with regards to RMDs, because it is mandatory and it's dependent on age. So anyone who's going to turn age 73 in this year, in late March, early April, we will send a letter to them. We'll do the calculations of what the RMD amount should be for them, let them know that they're subject to that RMD and that they need to take it in the course of the year. So they'll get a generic, statement like that, which any would have had it still been age 72. But that all could take effect in late March, early April. And then if they don't take their full RMD, another notice goes out in, I think it's mid-October, to remind them of that requirement. And then if they don't take it before the end of December, then we automatically sweep that out.
Yeah.
There are a couple steps along the way that they'll get reminders of that too.
and that's helpful. I think the one point that I would add to that is, what about the one who's 70 or 71 or 72? They should be planning on a future, and so they can be working on towards that now, making additional plans in their portfolio to deal with those kind of issues.
Correct, yeah.
And I would say with these provisions too, I mean, it's pretty easy for us to do a 5-10 minute webinar explaining it. We can do it, record it, send it to you. That's a pretty good communication tool as well. So any of these provisions we get in, and we could look at those and say, hey, let's go and work with Voya. They can pull us a list of, hey, who's 70 and older in the plan, and then push that out specifically to them. So there's that ability to do it. And yeah, I think to Rob's point, there's, for a lot of these, it'll be a very select few that will probably impact, and you'll want to. I think we would advocate be targeted in that, because Rob, if you read it for 10 seconds, you read 7 seconds past the rest of it.
Yeah. That's the attorney part.
So why don't we plan on, for the May meeting, let's have a discussion about the communication that we want to do at that time.
Okay.
And Brandon's really excited, I know, to kind of head that up.
All the questions come back to him. Is
with
that what it is?
yes.
Yes, I get it.
With help of Voya and Soltis, but I think that's a very good time for us to do that. So if
And maybe a targeted approach works
Yeah.
better.
yeah.
That might be 5 emails.
Yeah. I mean,
I
you'll
don't
have
know.
some required that will go out that are kind of going to be generic, but I think we're more than happy to help, because the target is much more effective to the right people.
I
with the
agree.
issue that is addressed by them. So
Thank you.
there is on page 13. We may not take the time today on that, but this just on page 13 is kind of a quick summary of, I think, those that you'd kind of qualify as some of the most important. Some of these won't apply to you, like tax credits for startups, but you can see the emergency savings, that provision that does, can go into effect 2024. Student loans, that one's a very big one. That's optional. You can choose in your plan to have dollar match to if student loan payments that your employees may be making. That can go into effect 2024. The forced out is being increased from 5,000 to 7,000. That's in place today on your plan, so that would be one of those that will go into effect next year that we'll want to communicate. Automatic enrollment, don't worry about it. This applies to new plans starting in 2025. So just for some context, you can kind of see what's happening here in the industry. When you look at auto enroll, it moves the needle pretty dramatically for participants. And so this piece of legislation is pushing plans. In 2025, any new plan that gets rolled out has to have an auto enroll in place. They don't have to match, they don't have to, but it has to have auto enroll. So you can kind of see where things are going that way. And then there's some things around catch-up contributions and others that we'll take time to go through with you. So this isn't all of them. This is kind of, we did a quick summary just of those that we thought, one, caught most people's eyes or created the most concerns. I think the auto enroll, as you can probably imagine, we had quite a few clients going, are you telling me I got to go to auto enroll now? And if your plan's already running, you're grandfathered in, so it won't apply to you. This would be to new plans. But okay. We talked about the annual conference. Dates are April 27th and 28th. We'll just let the committee know. I know we sent out a save the date to all of you, and we'll have the invitation. The formal invitation should be coming in about the next week. We're trying to finalize it. Fingers crossed, have it to you before the holiday weekend. But if it gets to Friday, we'll let you have the weekend, and then you'll get it early next week. But that'll have the registration where you can go in and register. The different sessions, all those type of things will be in there for you to do. So we've got some great content. We've got some really good people lined up, and in terms of industry and experts, and we're excited for this year's conference. So it'll be at the same location we were at last year, just FYI. We'll kind of have all the details in there for that.
So I'm not sure who is able to attend here on the committee, but it's something I'd highly recommend. For the members of the committee, if you're able to attend, it's very useful time and very, very useful information. So I know you're busy, but try to attend if you can.
Okay.
Did they get the building done, or is it still going to be
So
temporary?
it'll be in that same building. However, they do have it air conditioning and heating.
Okay.
I probably clarify, like we're not out in the wilderness someplace, but we did it last year in conjunction with, there's an LPGA championship tournament that's there, and they approached us and said, we'd love to host you here. So our meeting sessions are actually in the morning before the tournament starts on that facility. So kind of a unique place, but yeah, we got heating and air conditioning because it was a little chilly in the morning, and by the afternoon it gets a little warm and down there. So okay. On the ESG, I'll just provide a quick update on that one, and because we covered it in 2022. The previous administration around ESG plan sponsors were coming saying, hey, as far as ESG criteria, as a plan sponsor that offers a 401k plan, can I use that criteria to make investments available to my participants, or can I not use it? And so the Department of Labor provided some guidance in 2021, in the last administration, and that guidance was that plan sponsors had to evaluate and make investments available on the menu for participants based on their risk and return metrics. In other words, they had to qualify to be in the plan based on, like every other investment. They had to have good risk and return metrics. They had to perform at certain levels. They had to meet the criteria that you would expect all other investments to meet. Additionally, the Department of Labor in that basically stated, we do not want plan sponsors to, for lack of a better term, say, hey, we're going to support a certain industry or whatnot. We're going to reflect that in our retirement plan. And at the time, the Department of Labor kind of came and said, we don't want plan sponsors to feel like they have, maybe particular views that all of their employees now have to deal with. So again, for lack of a better term, the current administration came out late last year and basically reversed that. And they basically said, hey, if you want to use ESG criteria, you can, we allow you to in doing that. So it comes down from a plan sponsor standpoint of a little bit more of preference of, hey, do we want to be using ESG criteria heavily in the criteria that we have for evaluating investments, or do we not? I can tell you from our book of clients, kind of across industry, there's a lot more noise around it than there is implementation. In other words, you haven't seen this big demand from plan sponsors coming out saying, oh yes, we're going to really heavily implement ESG criteria. There's a few organizations that have gathered some publicity that are being a little more, I would say, a little more on the forefront of that. But for the large part, I guess the best way I'd say it is I wouldn't say it's necessarily being driven by the market or plan sponsors. It's kind of more of an issue at the government and political level that's kind of filtering through, and we'll see how we do that. So from that standpoint, that type of criteria before, you technically couldn't say, hey, we're going to put a green fund in. I'll just use that as an example because we want to take a stance against oil, so we're not going to allow anything in our menu that would have an oil company in it. You couldn't do that based on, a stance of, hey, we're against oil. Again, I'm just using that as an example. So the last ruling by the Department of Labor kind of said, yes, if you do want to use that type of criteria, you're allowed to. So I guess that's kind of the new stance or position of the Department of Labor in terms of that. I think the question we have for this committee is there a preference or desire to try and integrate or begin to look at specific ESG criteria that need to be part of the investment policy statement. And I will say that in the process that we have, there is some of the criteria that we're using today and that we get from third parties that it could technically qualify a little bit as that in how they look at and do that. But it's not specific criteria in your IPS today.
So is this, something we need to, take action on at this time?
No.
Could we go through additional, training information before we comment on this?
Yep.
Okay.
Yeah, so we'll put as a follow-up just to kind of go through and give you an example of what ESG criteria may look like. This is kind of the challenge with ESG, is because the definitions of it are so varied.
So my sense is that, and of course I would want to hear, from the members of the committee, but my sense is no. The committee and Utah County probably would not be interested in using ESG, criteria, but I'm making assumptions there.
Sure.
So, but yeah, I think we'd like to know more.
Isn't this becoming more and more of an issue though on the state level? I know the state treasurer's been heavily involved in looking at this. I don't know exactly where everything sits, but I know I'm starting to hear rumblings from other treasurers and so forth.
Yeah, so Kim brings up a great point. I was going to bring this up, and it's not to take a side or whatnot. I will say this is a rather politicized issue. I think for those of you may be aware, the state of Utah, the Attorney General from the state of Utah and the Attorney General from the state of Texas are kind of leading the effort with, I believe it's up to 26 states that are suing the Department of Labor over this, saying, no, we don't feel like you should be able to force people or kind of push your views. Again, I'm trying not to take a side here, but so there is, and the state of Utah is one of the leaders in doing that. There's also a couple of firms that have been pretty vocal about in support of this, BlackRock being one, and there's been a number of states that have liquidated all of their funds from BlackRock because BlackRock does use this criteria. And states have said you're in breach of your fiduciary responsibility because you're not evaluating investments on their merit and their performance, but rather on their political views or their what we view as criteria that doesn't lend itself to the best return for the actual employees or participants, which is a breach. So it is a pretty heavily politicized and kind of hot topic, for lack of a better term. But sorry, Rob.
No, I would agree. That's my concern sitting here as an attorney. I'm thinking as a fiduciary responsible to county employees for these funds and what we do, are we personally liable if we go that route as opposed to trying to maximize the returns, the fund options for employees, and we choose to artificially choose other ones that would meet those criteria, I mean, you can make an argument that we would be responsible for those decisions and might be liable for those decisions. And that's a concern that I would have.
As would we. So as a fiduciary on your plan with your investments, we would share the same concern of, hey, are these criteria? I'll state for the committee today, the investments criteria that are in place does not include specific ESG principles. Every investment in your plan has to meet certain bars for performance, risk metrics, portfolio construction, and then their merit based on how they've returned over the long term.
You seeing anything as far as pressure from federal government or taxpayers, because we're a public entity with public funds, that they're putting pressure on government entities to comply?
No, we're not seeing that. And I will say the communication that came from the Department of Labor that was very clear in that, hey, if you want to use these, we're telling you that you're okay. A lot of plan sponsors under the previous administration, when they said you can't just use these, you have to use performance and risk criteria. They were kind of careful not to say, hey, well, even if we want to, we're not going to, because we're then using criteria we've been told we shouldn't. And the Biden administration has said, hey, we're saying that you can use that if you want, but there hasn't been.
There's been a court case.
We haven't seen that come yet.
Tyler, I'm new here. Haven't been trained, so it's a lot of questions.
He's got all the answers though.
So my question is, the portfolio funds that we have available, do all the employees invest in all of those, or do they get to pick and choose?
They get to pick and choose.
So if we had employees, because we essentially represent collectively the employees' desire to have certain funds, if we had employees that wanted this type of fund or any other, tech fund or any specific industry, regardless of the performance, and not everyone had to choose, it was totally, it just became one of the options. That doesn't necessarily mean employees are going to suffer. If it became something only those that chose to do that invested in and lost money, but that made them feel really good, I'm not opposed to that. So maybe we ought to learn more about it.
Yep.
And send it out, see what the employees want. If there's hundreds of employees that want it, let's give it to them.
Yeah. And your question's a really good one. I'll say that. That's the way, I think, in terms of if you did want to offer it, it would be, hey, this is what it would be. And it wouldn't be, what we haven't seen is plans that have come out and said, hey, we're going to have a full ESG lineup, because they know that right now there's a lot of litigation around all that. But to your point, if there was if there's enough appetite, like we would look at it like a technology fund. Hey, if there's enough appetite, then we would say yes. We can go look at funds that would be labeled as ESG, and then we would have, the way we would approach it today is we would say, okay, they have to still meet the criteria. So just because they're ESG doesn't mean we'll turn a blind eye and say, well, we don't really look at their performance. We'd still say, hey, they have to meet this criteria, and if they qualify on that level, then we could put them in the plan, and you'd be protected, and as would we, in terms of saying, hey, it still follows the process, and it's an investment just like any others that if employee wants to go into, they have their ability in their own account to opt into it.
So do we have any experience yet to know, are there existing funds
Yes.
yet that would qualify by our criteria?
Yeah, so we have a couple of funds today that do meet that criteria, that if a plan says, yeah, we want one of these in the plan, that we have a couple of options that we can make available.
So just to close the loop on this, do we ever do a survey with employees to ask them if they care about anything but performance? And if not, maybe we should think about it.
So my question is, do you offer an ESG option for each of the various categories that we offer? Because you're talking now adding a lot of
Yeah.
new fund options, which could be complicated for some people, and maybe you'd have an ESG track and a non-ESG. I don't know how you do that, but
yeah, the short answer is no. There's ESGs. So again, part of the challenge is it's the complaint around ESG is what might be considered ESG to you is not ESG to me. And I've sat in these meetings where you've gone through an ESG fund and you've had probably the most vocal ESG proponent look at it and say, there's no way I would buy that company. They're not ESG friendly. So this is part of the challenge. So the offering for ESG, I would say, is somewhat limited, and you've actually seen the SEC go after some firms that have marketed their funds as ESG when they're not. There's a couple, Credit Suisse, and this is part of BlackRock. And so to your question, Kim, no, there's not like we wouldn't have an ESG op all across the menu. It would typically be where you mostly see it as U.S. large cap. And that's where funds that focus there, that's where you typically see that offering. You do see some companies rolling out like a target date fund that is ESG. And what I'll tell you there is we've seen more pushback than we've seen adoption for sure.
But that's part of the problem is there's no standards to measure against to say, yes, you're SG, no, you're not.
Yeah. There's that. I'll say too, I mean, there's been ESG is kind of a new term for socially responsible investing, which has been around forever. And the big knock on socially responsible is long term, the numbers flat out haven't been as good. Now I'm making a general statement that might not be true, but for a long time, if you look at socially responsible ESG or whatnot, one of the big arguments has been when you look at the long term numbers, they're just not as good. The returns are not as good. Hence the reason you have these states that are suing because they're saying, hey, you've been using this. We would have had better returns had you not been putting this criteria into your process.
Back to Rob's point.
And I like Jeremy's suggestion, and maybe if we had something that just identified these are the ones that are was it EK, not EKG, it's ESG. Sorry, that might be helpful. Some investors in the county county employees who might choose to go those investments may go hard for those investments. But we've also kind of addressed this, Jeremy, with cryptocurrency. We were kind of looking at that because I've had employees come to me and say, I'm interested in having that investment. We've kind of talked about it, and it's pretty high risk, and that's something not sure we wanted to offer. But it's kind of, in a lot of ways, a similar kind of vein. It's not in your typical type of investment to try to maximize your dollars.
Yeah.
So it can, but it can also maximize your losses too. So yeah, we haven't offered it. Yeah.
And sometimes you have to protect the employee from themselves too. I think you got to be really careful. Walk that line.
Yeah, and I think just to communicate to this committee that, Soltis, we've developed an ESG policy, and that is, hey, with our clients, we will continue to evaluate investments based on their risk and return metrics. And then when it comes to ESG, we'll typically just turn to the client and say, if you have a preference, we'll do our best to work with it. But in terms of our baseline investment analysis, we're going to ignore and put some of those other criteria on the side, and we're going to continue to look at risk, return, metrics, and merit based on the investments that we select and use. So that was supposed to be short, but this is good. This is a great discussion, and this is why we've added to the agenda. Is it has changed. It changes the discussion a little bit, and we'll have as a follow-up item to take some additional time on what that is, and then we can kind of go from there. And I think it'll be, like I said, it'll be interesting because, like I said, there's 26 states right now that have signed on to this lawsuit. Utah being one of the leaders, Utah and Texas being the two leaders of pulling it together. And where ESG may end up, well, I guess we'll kind of wait and see a little bit because there's valid arguments on both sides as to whether or not this has a place or doesn't. So.
Yeah.
Okay. Any other questions around that? Good discussion. All right. Now that we've teed up ESG, I'll turn it to you, Bishop, and we'll let you go before we jump in and do participants and investments. How's that?
All right. Well, thank you.
We'll let Boya define it for us. How's that?
No. We're boldly neutral right now, I think, on that issue. So prefer me to say it that way. So thank you for everyone's time. Good to see you all in person and to be here with you today. A couple pages that Tucker added to the front of the report here just kind of break down the full details on the ease account and spending account for the plan. If we want to move forward a couple slides, I'll just go to the summary slide, I think.
Wait,
Can I do that? Actually, go two more, I think it is. Two or three more. Slide, should be slide 5. Let's go to slide 5. We'll just go there. So this summarizes all of those pieces for you just in one slide to show you what balances we're carrying on behalf of the county right now. You have a spending account in both the 401k and the 457 plan. Those two accounts transferred over to us during the transition from Prudential, and that's holding roughly 109, almost $110,000 in assets there. And then you have the 3 ease accounts, each one attached to each of the plans that you have, the K, the 457 plan, and then the time limited plan. Those accounts actually capture the fees each quarter that are assessed against participant accounts, and then also are reimbursing expenses as we go. And thank you, PJ, for your help as we've moved through. But what you see here is as of the end of December, those 3 accounts had a total balance of $25,538, bringing your total assets available to the county at $135,445.97. We have made some expenditures from the ease accounts as of the first quarter, so that's bringing that down by roughly $20,000. But again, it's kind of on a rolling basis, so we'll always assess fees and then be paying out fees as well as we go forward. All right, if we could back up a couple slides to slide 4 for me, just, you want me to do it? That one? Okay, got it. All right, so just to highlight for you the summary of the assets within the plan, great news overall. When you look at the ending balance for each plan, you look at appreciation, depreciation captured through the fourth quarter, all positive. The positive note for each plan is that you're now in total assets reflecting balances that are higher than you were at the end of the second quarter of last year. And as of this morning, up still again, even with the market volatility that we've seen over the last couple of weeks. So good news overall, good news for participants as their assets are continuing to grow, as part of the plan. One item to highlight for you on the left-hand side under the 401k plan, the contributions were not $2,600 during the quarter. It was 2.6 million. There's a slight typo there. I think autosave was my enemy on that figure, but 2,670,938.70 to be accurate there. That one? Okay, got it. So just moving forward, just to give you the same glimpse of the assets in the plan, just from a graphical standpoint, again, you can see in each of the plans, the assets except for the 457 time limit, or excuse me, 457 plan are above those Q2 ending assets. But again, as of this morning, they're all up over those figures as well. Plan participants, just looking at that as well, you did see slight growth in the 401k plan, as well as the time limited plan, and then a slight reduction in the number of plan participants for the quarter in that plan. Tyler made a few comments, as did Tucker, on the managed accounts. So we're capturing the managed account activity for you as well. From a participant standpoint, you are seeing a slight reduction in the number of participants in managed accounts in both the 401k and the 457 plan. All total, slight decrease overall when you look across the 3 plans. The time limited plan did stay flat. I would ask Tyler or Tucker if they wanted to comment. I imagine part of it might be because you're default enrolling now into those accounts, and some people might be changing as a result of that, but I don't know if you had any insight or.
Yeah, so I think maybe 2 comments. I think, right, it's a new, when you go from Goalmaker to that, it's new. And inevitably, there's a few that just see new and say, I don't like new, which was fine. And we've helped them in doing that. To Bishop's second point, just like Goalmaker was, this is your qualified default. So somebody that comes into the plan doesn't make any investment election. They get defaulted into this, but they're able to come out of it at any time. So they may get enrolled and then a couple months down the road say, oh, hey, I want to go and pick some of my funds. And they just opt out at that time. So anything you would add, Tucker? Because
Yeah, I mean, interact with the employees on that. That's usually the case. I think it's just because it's new. And one thing that I think is a bit different is we're a lot more transparent as far as how it's charged, right? The fees on this. And so that we think that might be another thing too, is because we're upfront with the fees. that might also be a reason. But
Yeah, Goalmaker, the fees were just embedded in it, so they never really saw it, whereas in managed accounts, we make sure the fees have gone down, but
they see them now.
yeah.
And then just looking at the assets within the managed accounts as well, you can see total assets is $64.1 million at the end of the quarter, just about where they were at the end of Q2. Again, assets coming up. Imagine part of the decrease in these plans is assets moving out, as participants moved out of these holdings as well. Just to look at assets just a little bit, I did this for you last quarter just to give you a sense of where participants were holding a single investment option, and part of that was just giving an eye to whether or not there was a flight from a variable asset holdings into the fixed account. So just looking at the far left corner there, you can see in the 401k plan, we did see another roughly 50 participants move into just the fixed account over the quarter. I would have to look at it a little bit to see what the timing was. Hopefully they didn't do it too late in the quarter because they missed that bounce that, the plan and others experienced as a result. But we'll keep an eye on that just to see how that looks as we go through time as well. But the rest of the funds where you had single investments are roughly the same, and the 457 plan was mirroring the same as well for the prior quarter. And then this just gives you just a graphical view of what had occurred. So. Real quick, with regards to participants' participation rates in the plans, these are all just updated with the most recent numbers. As Tyler said, slight difference, I think, in how we capture it. So we're showing 99.3% as the participation rate at the end of the quarter or fourth quarter. In the 457 plan, slight decrease there, 16.6%. And then now with the conversation that I had with Brandon, we're showing 100% in Q4 in the part-time limited plan. I need to look back and see what our system is capturing in those prior 2 quarters. We're still showing it as being off. So I don't know if that's a difference in what our plan review was capturing at that point in time versus now, but we'll look at that and try to manage through those numbers and make sure they're reflecting properly. Because as my conversation with Brandon was, those two should be roughly 100% as well in that category. On distributions, you did see 93, so total distributions were up by 30 from 63 to 93 during the quarter, but overall distributions were down from just over 3 million, 3.1 million down to 1.3 million for the quarter. And then as we did last quarter, we broke that out just so you could see what the top 10 rollover institutions were. A little different last quarter. And from my experience, you typically don't see any rhyme or reason as to where they land. Kind of depends on both asset size of the account that's being rolled out or the number of assets that are being rolled into a specific firm as well. But Athenia Annuity Insurance picking up the lion's share of assets during the quarter. Capturing for you also the loan information. Loans, although total number of loans did drop slightly, 184 down to 180. The total number of loans, both residential and general, are roughly flat, as are the dollar amounts that are within the outstanding loan balance, and then the general loan balance and residential loan balance there as well. Total new loans initiated during the quarter were 8, though, so just up 1.
That's a good trend, by the way.
Mm-hmm.
That's not a trend. We're seeing the trend the other way with a lot of our clients, as you can probably imagine.
Yeah.
Inflation and people's budgets feeling stretched. So the fact that your plan continues to see loan utilization decrease is a positive.
Looking at participant services, it's only partial data here because our system is having a problem populating our report correctly. So you have at least the usage within the internet and mobile technology as to how people are accessing their account. You can see those figures reflected for each of the plans. The voice response system and the call center, although not picked up here, on the next slide, I am able to report what the usage was of the call center directly. So you can see this is similar, I think, to last quarter where, number of calls coming into the system and accepted were identical. There's no abandoned calls taking place. And with regards to the speed to answer, that's that ASA, average speed to answer. category, you can see the average speed is pretty quickly, average of 22 seconds across the whole quarter. And then you can see the length of time for the calls and average wrap time as well. So overall, pretty good. Typically our busiest time is in the first quarter of the year, right after Martin Luther King Day, actually. A combination of factors. It's a holiday, pay period usually hits, and then also people's taxes are starting to be developed. So that's usually the first quarter is usually the busiest. So next quarter you'll see a pretty good increase in probably average answer time as well as handle time for calls also. And I probably won't do much on this slide. Just included it just so you knew. From our perspective, the three key things for governmental plans, with regards to the Secure Act, and know that Tyler and Tucker have information for you. We included a chart for you and been providing updates to that to Brandon and Ralph and the team as well. So look forward to being able to answer your questions as we go forward with implementing the Secure Act 2.0. Okay. That's all I had to cover today, unless there were questions that you had for me.
I have a question, not so much on your presentation, but in
Sure.
the booklet, comparing year end to year end.
Okay.
Like on page 28, the 401k, we went from 185 million down to 146 million year over year.
Okay.
I assume a lot of that's due to the market
Mm-hmm.
losses.
Yeah.
But the question,
I thought that was just your 401k.
mine was in there for sure. I don't know if there's anything else affecting that. That's just a huge decrease, obviously, and I'm guessing most with the market. But what about the 457? It went from 2.4 up to 19.
Mm-hmm.
Is that right? And then the deferred comp went from 27 down to 2. I don't know. I don't know what's going on there.
27, I guess, which, you're looking at page 28, you said?
Yeah, but on 30 is the deferred comp plan. So 29 and 30, there's just wide swings in year over year, or I guess it's 6 months with 457B. I don't know. I haven't paid much attention to that in the past.
Those has to do with I think, as we combined them, but
Oh.
on your end, in terms of tracking them. So I think that it's not like there's been a huge influx or change in value. I think it's just how it's being tracked on Voya's end.
Okay.
From those plans where they're worth 3 and we combine them to,
Look at the next page and you'll
Yeah.
see it's what it
Yeah.
says. You'll see how in 2021, the fund was at 27.
Yeah.
And they put it to, so it's.
page 30 on the packet, Kim.
Right. Yeah.
Yeah.
It goes from 27 down to 2.5.
Yeah, and then if you look on the page before, it went from 2 to
2
19.
to 19. So it's just
So it's-
basically
Yeah, and that's
by
probably the limitation
combining.
with our system, because in our system, it's looking back when those plans were separate.
So if I understand what you're saying that the 27, which was in the deferred comp plan, moved over to the 457, which is the 19,
Yes.
and then the opposite was, yeah, I think that's right. And okay,
Yeah, and that's the part that
so it
I'm,
just kind of got reallocated to a different.
yeah, and
Is that a fair interpretation of what was just said?
yeah, and we'll circle back on our end, because it's within our tracking system on these reports, that's where it's pulling on. It pulls from a feed that we get from Voya, and it might just be the way the feed's coming through.
Okay.
So, but what I would say is that 27 million is that 19 million or so number that you should see there, or 21, excuse me.
So it's good to have accountants on this board.
Yep.
The lawyers cause all the problems. The accountants they spot the real issues.
We'll get some clarification back on
Thank
that,
you.
but that's I think just an internal kind of limit in terms of the reporting that we get. Okay, let's jump into on the investment portion. We can finish. There's a couple of items we want to touch base on there, and we'll probably start with your comment, Kim. Yeah. 2022, we've had some good years. 2022 is not one of those in terms of the market. So we've had lots of conversations this year with participants and employees. When you add in a difficult market, then you add in inflation, and then Kim and I were talking in the latter half of the year, you started to see pretty significant layoffs happening. It's been a tougher environment, I think. And you can see that kind of in those plans. Let's go to page 32 in the packet. So the bad news is, in terms of overall market, absolute return, pretty tough year in the market. Again, we've had some good, strong years, so I wouldn't say it was entirely unexpected, but certainly, participants have, well, I shouldn't say participants, we've all gotten used to, you open your statement and it goes up and it looks pretty good over the last, I'd say 8 years or so. It's been pretty steady, other than 2019 was flat, but other than that, you've seen pretty steady decline. So two tough things in the market last year. One is equities came off, and I don't think that's what alarmed people. The challenge you had was equities came off between, depending on which index you're looking at, between 25 to about 35%. So pretty sizable drawdown. Certainly not an outlier by any stretch, but a pretty sizable drawdown of what you would expect to see in an equity market in a tough year. The more difficult part was bonds. In a year where you see equities drop like that, you would expect or hope bonds would be flat to positive, helping to offset some of those. And with interest rates being ratcheted up by the Federal Reserve, you saw the bond market lose about 15 to 20% too. So you had participants that maybe like in a 60-40 portfolio, 60% of their portfolio is off by 30, 25 to 30, and then their bond was supposed to help them because of the interest rate environment. It was a pretty difficult, off 15 to 20 on that. So I would say that's the most difficult bond environment we've seen since the Great Depression, and it was a tough one, and there really wasn't a lot of place to hide. So if you look at bond managers, they have to manage bonds within a certain their parameters, right? So they can't go, hey, I'm just going to get out of bonds, I'm going to go buy something else. They still have to hold bonds, and when interest rates are going up, that's going to be a tough environment. So the good news is, if you look at the chart there above, or you're looking at the green, in relative terms, the investments in the plan performed quite well versus their peer group. So while we weren't immune from the downturn, in relative terms versus their peer groups, you see some pretty strong performance. You'll see right now there's actually no funds on watch. You see the one that's there, that's the one that's in process to be changed out. And so right now there's actually no funds in the plan that are on watch. If you look at the bottom of that, you'll see right now that the average excess return of the managers in your plan is about 1.97%. So flirting with a 2% kind of outperformance versus their relative benchmarks. And then you have about 88.76% of the managers in your plan have outperformed their benchmark. So tougher year in terms of absolute terms. In terms of the investments and how they're doing versus their peer group and their categories, actually had a pretty strong year. And the green kind of highlights, we call them manager highlights, but those are managers that are outperforming by 1% or more kind of over their peer group. And you've got 10 of those right now in the plan out of your 19 funds. So more than half the plan outperforming at a pretty significant rate, on those. So, and as I mentioned, there's the one fund on watch that shows up there is that Metropolitan West, which is in process to be replaced and should happen here in the next couple of weeks.
On that, we usually put that on the commission agendas that we usually do. We replace a fund.
Yeah.
And has that already has already happened? Okay, thank you.
We're just on the tail end of it between getting the commissioner's approval and then it has to be a notice that goes out to the employees. You got to give them 30 plus days before you do it. So everything's done there. It just now waiting for the change to
I
happen.
couldn't know the process. Thank you.
Yeah. The next thing I wanted to mention is we talked about this in our last meeting, but we've been fortunate enough to continue to grow your target date funds that are in the plan, both in the 401k and the 457. We are at a additional price point that we've been able to kind of get to there with Soltis's size, so we qualify for a little bit of reduction there, and we would propose the exact same fund that you have in your plan today, but if we replace those with the lower share class that we have access to, it's about another $15,000 of investment costs that would save your participants. to basically move to the exact, you're in the exact same fund, just lower share class. So that would be technically it is a fund change, and notice to go out because you are going from one share class to the next in doing that. So that would be one that would need to be approved, and we can go back to in terms of putting in place on the plan. Unless there's opposition to that.
Are those the target date funds that you're talking about?
Yeah,
Okay.
it's these T-row price, it says SIA target date. If you all remember, we have a collective investment trust that we've been able to negotiate with our size. And as we've continued to grow, each time we get to another break point, we get a little bit of reduction, and we're there.
So just so we're clear, are you suggesting then that we replace the target date 2020, 2030, 40, 50 with the T-row price retirement balanced?
Yep, no, it would be the exact same. 2020 would be replaced by the 2020, 2030 replaced by the 2030. You'd keep all the same vintages, you're just going to a different share class. It's a little less expensive. So exact same fund for all the participants, they're just paying a little less.
Same name, basically.
Yep.
Okay.
Yeah, these will actually see the T-row price name because this allows us to go directly with T-row and get them. That's why it's a little bit lower. So
Same hamburger, just cheaper.
yep.
I like that. Seems like a no-brainer.
So, and I'll go back. Tucker, you can maybe help me here. I think initially when we looked at this, maybe I won't ballpark it because my memory's probably not good enough. But again, that's about it'll be about 15,000 a year, and as those assets continue to grow. So, I mean, there's been pretty significant savings. And as you can see, those funds are 4 out of 5 are on highlight. All 5 outperformed their benchmark pretty significantly, and 4 out of them have outperformed by more than 1%. So they continue to do a good job for us.
So we need a motion, wouldn't we, on that to recommend that change to the commissioner?
Yeah. If that's what we want to change, if that's what we think is the best thing to do, then we are going to need a motion, to do so. Does anyone have any questions about that change?
I like the analogy of a hamburger for less cost. But...
We'll put that on the notice.
Yeah.
And put Kim Jackson said this.
Okay, do we have a
After Rob
motion?
whispered in my ear. Well, I'll make a motion that that we go ahead and replace the target funds with the T-row price funds that would give us a lower expense ratio. Does that sum it up? Okay.
Okay, we have a motion. Do we have a second?
Second.
We have a motion and a second. All those in favor say aye.
Aye.
Aye. Motion passes 6-0.
There was Rob. Okay. Let us know in terms of if you need any help in terms of that recommendation or language for the commissioners. Cheaper hamburger. It probably works for them too.
That probably would.
Okay.
All the ingredients are the same.
The other follow-up item we had from our last meeting had a discussion about a couple of additional potential options in your plan. We talked specifically about bonds last time and kind of the difficult environment. And one of those questions is there a bond option that we could look to put in the plan that wouldn't be so detrimentally impacted by rising rates? I think most of us can probably know that the Federal Reserve has clearly communicated they're going to continue to raise rates throughout the year and will continue to do that until they really see inflation begin to slow down significantly and get to more normal levels. So we think that environment's probably not going away. There is what's called inflation-protected bonds, or TIPS, Treasury Inflation-Protected Securities, where they are bonds that are pegged to inflation so that when rising rates go up, that they are not negatively impacted. We do have, if you look in that inflation-protected bond market, it's a pretty efficient market, Treasuries being the largest part of it. And so we do have an option there that we use in quite a few of our plans. It's an index option because we do feel like the market is very efficient there. It's really hard to get kind of excess performance in that particular part of the market. And so it's on page, it's the Fidelity Inflation Protected Bond Index.
Tyler, I have a question.
Yeah, on page 44.
Can you explain why, as rates go up, that they're worse investments? Like that doesn't
Yeah.
track for me.
So when you buy a bond, bonds have what's called an inverse relationship to interest rates. And because of the way that your return on a bond, you're getting paid, you're lending money and you're getting an interest rate back. So when you buy a bond, and let's say that bond has a 2% yield on it, you're getting a 2% interest rate back from your investment. And if rates are at 2% at that point, your bond's pretty fairly priced to the market. If interest rates go up to 3 or 4%, and you can now go buy a bond that will give you a 4% return, the price of that bond that only pays 2 goes down. The market prices it down. And so it basically loses value. And so as interest rates have gone up in the last 18 months, bonds that have been offered, the price of them in the marketplace continues to go down or essentially lose principal to where the interest rate that the investor is getting is being negated by the discount that that bond trades at. Therefore, you have a negative return that can happen in bonds. And so when you kind of think of bonds, if just think interest rates go up, bond price, typically your bonds are going to lose value. And then the same is true in a lowering rate environment. When you have rates that decrease, you're typically going to see bond prices go up and you'll get pretty good returns.
So it's based on what the future of the rates is. Okay. Thank you.
Which is why Federal Reserve meetings are watched way more closely than they probably should be. Might be the most boring meeting ever, most attention, but interest rates and what they're doing with them is the primary driver.
And how do these bond managers decide whether to sell and realize the loss versus hold on to them to maturity?
Yeah, so every bond manager that has a portfolio, right, they have sell disciplines. It's one of the things, well, they should. It's one of the things that we look at, and which is, hey, when do you buy a bond? When do you sell it? And they'll have parameters where it's kind of like cut your losses of, hey, this bond, it's really getting beat up, and rather than keep having downside exposure, we may sell it. The other part of that is just daily cash flow. To be perfectly candid, bonds have seen outflows, and you have managers that are, you know, if you're managing a fund and you get a request to redeem $10 million, you have to go sell what you own. Now, most of those bond managers, they manage that pretty well, and bonds are liquid, so they can try and make sure that they're not being forced to sell things that they really don't want to realize losses. But did that happen last year? Absolutely. With some of these, you know, with some bond managers for sure. And those are things that we try and look at with them: is how much cash do you hold, what's your sell discipline. You know, some bond managers will pay very close attention to rates. Some bond managers candidly will say, hey, I can't predict where they're going, so I just try and build a really good bond portfolio. And so there's kind of all types of strategies around it. This particular fund, if we were to add it, it would be an add. So we're not, we wouldn't recommend that this would be a replacement of any of the funds in there because it's a little different. But this would give you another option in the bond options in the plan that would offer inflation protection. And so, for those participants that don't want to be in the stock market, that want to be more conservative, but are also worried about inflation, this could be a decent option for them to be in.
So if the return on these bonds is pegged to the existing rates, I assume when the rates go down, they will go down as well, right?
Yeah.
Yeah.
So you'll see them in terms of overall performance. You'd probably, if rates go down, you may not see like a negative return all the time. So it's not like it's absolute, but you'll definitely see them lag the bond market and what traditional bonds would be doing in that environment.
Anyone else have any questions about adding that as an option?
Did they do that much better than other bond funds? Because I'm looking at the year to date in the 1 year, and they're down 12.
A little better.
12
So they're
and
not
11%.
They're not immune. I would say two things: the rate or the rate in which rates were increased was rapid, and I would kind of say when you have the Federal Reserve going 50 and 75 basis points a pop, there's kind of nowhere to hide in bonds, even in inflation protected ones. But they did hold up. They did hold up better than kind of most traditional bonds in that environment. And if the Federal Reserve is a little more measured over the next year as they continue to raise rates like they have been the last couple of quarters. I think we would anticipate that these would hold up quite a bit better.
So if we add this fund, are you guys also going to add it to your managed account, or would you not include this in?
So actually, we do have a small allocation to this fund in our managed account
do you?
solution. Yeah.
Okay.
Yep.
Is there any issue on, the voice side? As far as adding this fund availability?
Yeah.
Double check just to make sure, but I wouldn't think so.
Okay.
Yeah, and it should be there when we look at your platform. It's an index fund from Fidelity, so which I think they're all there.
I don't have any issue with adding it as long as it is a option that could perform the current, bonds that we have in our funds. But I'm curious if anyone else on the committee has a similar opinion.
So we're voting to see if we can find a way to lose a little bit less.
Yes.
I think in name it may give a little comfort maybe to employees as they look at it. Maybe more comfort than in reality, but I don't know if there's been much request, Brandon, if you have heard from employees, hey, we'd love to see an option in there to protect us against inflation at all. I don't know if they'd even give you that question or if that would come more with the one-on-one meetings, but
I typically will always give an employee Soltis's number for financial advisement. If an employee, the number one request I've received is they'd like to move over to the guaranteed income or the Voya fixed asset. So that was a change. I probably had maybe 15, 20 employees that called me asking how to do that. And again, I always tell them how they can do it, but I always drive them to Soltis, to ask them if that's something with their portfolio they should consider doing.
Yeah. As far
But
as
no, nothing against inflation.
yeah, not that question specifically that we've gotten in our meetings.
And I would say this would be an offering that probably more sophisticated employees that are building and managing their own portfolio
would
be looking at. I would say for us, if they don't know what a TIP is or an inflation protected bond is, we'd probably, having them in a target date or the managed account solution makes a lot of sense. But we can certainly have the conversation and help them answer questions and look at it.
I guess I'm kind of on the fence.
Yeah,
on
I'm
this
kind of on
one.
the fence
I
too,
don't-
quite
I don't have any
honestly.
strong opinions to move
I
that
think-
direction, but I'm okay if the demand was high and people really felt like that was an option they were looking for. And the fact that you guys are investing a little bit in it, from the managed account side, I don't know that there'd be any harm, but I don't have any strong feelings.
Yeah, the more I think about it, the more I think maybe not. But I am interested in Jeremy and Rob and Yvette. If you have any thoughts, I'm afraid it may look like we're chasing something, and I don't necessarily like that strategy. Even though not necessarily what we're doing, but it could look that way, and we don't ever want to chase the market. I don't think.
I'm always a little concerned too about the number of options that we have out there. Do we have too many versus enough?
So you have 19. This would push it to 20. And I think 25 is kind of the threshold in terms of where I think the average plan out there has between 18 to 25 options in the plan. So you're right. You're right in the You're right in kind of where we feel like, hey, this is a good amount, but it's not overwhelming. Once you push 25, is you start to see participants struggle with, I got too much.
I don't have anything to add to the conversation.
Okay.
I don't feel compelled either way.
Any thoughts of that?
It's hard for me to approve something that we're not really compelled to do unless we see just a strong demand. So I guess my opinion would be, let's wait and see if we get a huge demand for it, because we seem to be constantly changing and adding different funds just about every meeting we meet for one reason or the other. It might be nice to hold off for another quarter or something and see what happens. I don't know, just a thought.
Yeah, I mean, I just personally, this is just own personal. I would typically say if there's not a strong appetite or really feel like, hey, I've got participants that are really wanting this. Usually less is more. And at the same time, this would be a pretty innocuous addition, you know, where you'd add it to the plan and say, hey, people, if they're worried about inflation, this is a pretty decent investment to help you in that scenario. And so it's not a high risk one, right? It's not like some part of the Bitcoin conversation where you have these huge swings of volatility. That's there. This would be a pretty conservative investment that would just give you another option for those that are saying, hey, I don't want to invest in stocks, and I want to have a little bit better maybe return than the guaranteed income option.
Plus, if they get inflation under control within, you know, by the end of the year, then I don't know, the demand would probably even come off of what it
Yeah.
might be at the moment. But I don't know. I don't know if anybody else has a strong opinion.
Can I ask a question? You have government clients.
Mm-hmm.
Are other government clients using these?
Yes.
Can you give us an example without violating any kind of confidentiality?
Yeah. So I will say this, in most of our plans, government's included. In terms of bond offering, the bond market, hope I don't offend anybody here, I'm probably not. The bond market's pretty boring. It's not quite like the stock market where you have large cap, small cap. Bond market's much more general. So in that asset class, we try and make sure there's good broad exposure. We usually do that. You can usually do that through one or two options, maybe three for those that want a high yield. But and so this would Metropolitan West and the Dodge and Cox that we're moving to. That's a good broad allocation. Like if somebody says, "Hey, I want to be in bonds," it's a great broad allocation to the bond market. If they want a little bit more, hey, I want a little bit more than just a broad allocation, a inflation protected bond tends to be usually the next option that we'll use because it does provide a little bit, you know, the risk. There's two risks with, I shouldn't say there's two, but the two main risks with bonds are interest rate risk. If rates go up, your bond can lose value, and two is your credit risk. Okay, they're going to default. So what this does, an inflation protected bond, why we use it is, hey, it helps mitigate interest rate risk because you're using an inflation protected bond. And then two is it's a tip backed by the Treasury, so chance of default's pretty low. So it's a pretty conservative, kind of nice addition to just add to somebody who says, I want a little bit more than just broad bond market exposure, but I want a little bit less interest rate risk or a little less credit risk. So most of our plans, kind of a long answer, Rob, most of our plans will have a couple of options in the bond market. Okay. Whereas today you guys just have one. But the one you have is a good broad, it's good broad exposure.
And your recommendation?
I'll kind of go back to, I think if we see there's good appetite, I think we would say, hey, there's a good reason to add this. It gives your employees another option. If the committee doesn't feel strongly about putting it in there, or there'd be good uptake, I think our recommendation would be, you know, less is more.
Have you been approached at all?
No.
Anyone in your staff about it? Okay. Thank
So
you.
I say we hold on this one. That's my thought.
Okay, which is great. The next follow-up we had was on a real estate side. So, and Ralph's comment about performance chasing. The first thing I'll say is this is real estate, but this is not residential real estate, as we know how it's been going in Utah County as well as Washington County all too well. Kind of going back to your question, Rob, most of our plans, we do offer a real estate option. The reason for that is historically real estate has been a good performing asset class in periods of inflation. And then two is usually when equities are doing well, real estate tends to do quite well as well. And so it's a good additional kind of asset to have in the plan. We use what's called a REIT, and there's two things for you to kind of know about a REIT. One is it's daily liquid, so this is a fund, trades just like every other fund in the plan, where your participants can buy in and sell out of it every single day. So it's not illiquid like real estate often is. Two, as you can see on page 40, this includes, again, this isn't, people flipping homes or even just buying residential homes or whatnot. This is apartment complexes, data centers, industrial warehouses, cell towers, hotels, shopping centers.
Does that include office buildings?
It does.
Because office buildings in certain markets are getting hammered right now with the remote work.
Yep.
But
So what you'll find with these real estate portfolios is that like any investment manager, they'll diversify the portfolio and say we want to hold not too much of one or others, and then they'll look at and they'll construct that portfolio full of with these different types of properties to drive a little bit more consistent return stream. You can see from if you look at page 41, kind of why REITs are attractive. If you look at them historically, they've generated a pretty healthy rate of return to investors. You can see that they tend to be a pretty good asset class all the way through markets. So, early cycle, mid cycle, you can kind of see late. And in recession, they're not immune either. But you can see for the last, 40 years or so in recessionary periods, they tend to hold up a little bit better than traditional equities do. And then if you look at those over the long term, they've actually outperformed stocks a little bit over that time period. So Cohen and Steers is the manager that meets our criteria and that we use and that we could put into the plan as an option in the plan. And so they're really one of the pioneers of of kind of what's called the REIT structure of how do you invest in real estate on a more liquid basis. And so they've been around, they've done it a long time, very good manager. Their numbers bear out. Really good management team that does this, and you can kind of see that on those. If you look down at page 43, you'll see they have been very consistent in kind of staying in that top quartile among their peer groups. But again, I'll point out, this is very much like an equity, like a stock, in terms of risk and return. You can see from last year, down 25%. When the markets go down, you're going to see these typically not have positive returns. They'll be a little bit more correlated like stocks are. You can see from the expense ratio at 0.88%, well below the category average, which is a little over 1%. And an option again. Similar to the inflation protected bond, we would not recommend this go in and replace any of your existing funds. So it would just be another option in the plan for those that may want to invest in real estate. I'll pause there and see what questions you have. Excuse me.
I don't know if I have any questions, but I'm kind of the same opinion with the other one. I think we should hold on this as well. That's just my opinion.
based on lack of demand.
Again, this is just my opinion. I don't see our employees being highly interested in this product right now.
Add to that, Ralph, has anyone reached out to you or your office or anyone else on the board asking about these?
No. But, to be fair, I don't think they know about them.
That's probably true.
Yeah.
Do we have any other fund that would be kind of close to real estate at all?
It's currently in the plan.
Yeah. Because I kind of like the
No.
idea of having a
Yeah.
real estate option for people, but I'm just, again, wondering, is the time right?
Yeah.
Would they understand it? Would there be a lot of demand to do it?
Yeah. The answer is no. Like today in your plan, there's not explicit real estate exposure. Now, if you look through your U.S. equity funds that are in the plan, I think you'd make an argument that there's some real estate exposure in there. Amazon's in the S&P 500, but Amazon's also one of the largest real estate holders in the country with
All their data
their
centers
warehouses
and warehouses and whatnot.
And actually, what's happening is you see these REIT structures going to Amazon saying, "Hey, we'll buy it from you. You can lease it from us, or you don't have to worry about having a building on your balance sheet." So it's kind of one of the reasons But yeah, short answer is no. There's not explicit real estate exposure in your plan today.
Out in the managed accounts, are you limited to just the same funds that?
No, that's
Yeah.
the benefit of the managed account is we can go in and we can use it. And in full disclosure, we do have a little bit of exposure in real estate in the managed account as well.
Okay.
We do see it as an asset class in a total portfolio that it makes sense to have a small portion. And I tell you like a 5 to 7% type weighting in an equity portfolio for real estate to give you an idea of where we kind of typically see it.
I guess my opinion, Ralph, is I'm not against it. I think it makes sense to maybe have that option at some point? Is now the time to add it? I don't know.
Same. I don't. It's not something I'm really against. I think that. I mean, you could say it's on sale right now. Now's a great time to, but I don't know if our. Again, I'm making assumptions here. I don't know if our employees will want to. If this is something they'll see as an advantage right now. I think that they'll be a little bit concerned about investing in real estate right now, even though it's I realize it's an investment fund, but I'm just not sure how much it would be utilized. I think it's something I'd like to do, and this is something Jeremy mentioned. I think perhaps a survey is in order to find out what our employees really are interested in. If we can, it's not something we have really asked in the past, but I think if we found out that they had a fair amount of interest, there was enough employees to make it worth the time, then I think we should do it. But I think that's what I'd like to do. I think these are really good ideas, and again, it's not something I'm against, but I think we need a little more information before we make a decision.
I like that idea.
So I'd like to, yes, definitely that, and perhaps as we do that, we could get recommendations for what, if there's an obvious oversight in what's offered, and we're looking less than 25 is kind of the number of offerings you mentioned. So if we've got capacity for a handful more, if maybe we could get a recommendation for, suggestions or things that aren't well represented, to make that part of the survey, to say these are things our advisors have noted as perhaps missing. We'd like to know you're interested in having those. So getting recommendations on, if they want to do ESG or crypto or some other things, but specifically include in that things that you all see that are missing that would be advisable.
We can definitely do that. I think we can give you, hey, here's some, I'll just share with you a couple real quick. I think we have a number of companies. You can probably guess what industry they're in. They want a tech option, like a NASDAQ 100, where you can give them an option of, hey, if you want to invest in technology, here's a good fund. On the fixed income side, especially as rates have been low, we have some clients that will want a high yield. And I think, so there's room in there, but we can come back to you with 2 or 3 or even more of saying, hey, these are areas where today there's not an explicit option, but if you wanted to add that, I think it would be prudent to do so and give your participants, plenty of options to do that.
Okay. Well, I think I'd like to have something ready, for our next meeting, but I want to be able to discuss the results before that, if that makes sense. So I'll try to put something together before that.
Okay.
If that sounds okay.
And we can circle back pretty quickly with you on kind of these would be maybe the asset classes and then if you want to shuffle those around and.
Okay. That sounds good. Thanks.
Okay. I think that's it from the investment side.
Large cap? Do you want to discuss that?
No, I think we're good there. So I think we'll turn it over to Tucker and have him go through the kind of the report on the education front. Where do you want me to go?
Everything specifically.
Okay.
What I actually think we summarized it mostly just in the business calendars. So maybe not to repeat everything that we said there. We didn't really put a lot together for that.
Okay. So we'll I think around the education front, obviously we had pretty good increase with meetings with the transition. I think the efforts around your law enforcement side we'll continue to do. We continue to have multiple advisors here to help support and be on front of that. We'll also have kind of the quarterly webinar series that's happening. Our first one is coming here
Next week.
23rd.
Yep. Next Thursday,
You'll be getting an invite shortly, and that'll be on
the 23rd.
23rd, and the topic is
This one's going to be using the Roth pre-tax and HSA accounts in planning your taxes. We'll come up with a more snappy name, but that's the idea. So,
One aspect on that Roth, I have a unique perspective where I'm at in my lifetime, but what I'm looking at is that I've poured so much money into a 401k, a pre-tax option, now I'm worried about my RMDs coming out and not being able to plan the amount of income that's going to come, which affects a lot of things as you approach retirement.
Yeah.
And had I known where I'd be today when I was younger, I would have definitely put more into a Roth than I have. I'd probably split it up a little bit. I know you get the tax advantage of putting into a 401k, but you get so much in there, and then all of a sudden you get too much income, and it can affect your Medicare costs and other things. So there is some advantages to knowing about it early on and making a plan, which is where you guys come in, I think, and can help educate some of the younger workers that, hey, you may want to look at this Roth. There's some real advantages later on. So
Well, that's a good thing worth covering. Maybe on a general sense, that's exactly why we have these webinars, is to give them the information so they even know what questions to ask, right? A lot of times people will just say they don't know what they don't know, so they can't even ask the questions.
right,
But it's a good reminder to say that part of the services that Soltis offers, and we'll be reaching out, is anybody who's in the AMAs and even those that aren't part of the services, is building a comprehensive financial plan for them. And that involves discussions about what to do with these accounts, especially in your situation, Kim, stuff like that. What are your options? What is the conversion? What are the tax implications? And we can actually model that out to within a pretty confident precision of what the impact that would have on your retirement. And so, yeah, a good reminder as far as education goes in these meetings, no, a good majority of them will just be pulling up their accounts, especially for younger people, making sure that they've got the match, making sure their investments are correct. But we're finding more and more that the people that are 55 plus are doing a good job of taking advantage of the additional service, which is, let's look out 30 years. You know, you retire in the next 5 to 10. What does that mean? Are you doing what you need? And then what happens when you retire? What is your goal from there? It's no mystery. People, you know, we're told to prepare for it, but then there's often a lot of mystery as to what happens next. And so as part of the services, and that's why we try to be on site every month, just to show them that people do have a good resource that they can turn to for fiduciary advice and get a full service on their retirement plan. It's part of the service.
maybe a plug for that too is regulations are constantly changing. I mean, we're going to see, some sunset in 2025 with the tax rules, and there's always pressure to get rid of the Roth conversions. So you may have a small window here to do something between now and then. So, getting with you guys and getting updated on what those opportunities may be is important.
Yeah.
So,
Yeah, the Roth conversation is a very personalized one. It's
Right.
hard to use rule of thumbs on it, and then too, you throw in the uncertainty of what are the tax codes going to be over the next 5, 10, or even 20 years.
right.
But I think to Tucker's point, that's a great conversation. This is a topic that we do education on pretty regularly, because it's part of it's just helping them understand how it works, and then to helping them say, okay, we can look at your situation. And with that, if there's good data that we have, and in that planning exercise, we can have pretty good, a pretty high level of confidence of, hey, you should really look at this or not. And I think the last thing I'll just say is, you'll see in the new regulation, there's a lot more Roth. Your
right.
catch up and other things are going to force into Roth.
Right.
So it's kind of funny where the government has been, I don't know, say almost like, oh, I don't know about Roth. It seems like right now they're kind of pushing it because I think they're eager for some revenue.
Right.
Coming now as opposed to 20 years from now. So there's a fair amount of Roth that you'll see new Roth provisions that are in the new legislation that I think we'll want to make sure we communicate with people on.
Well, and the nice change they did too is they're treating the Roth 401k now the same as the Roth IRA, in the sense that you don't have the required minimum distributions. I thought that was a great change that they made recently. So.
Well, and there's one of those pieces of legislation, they're going to allow the company to match Roth. So right now, when a participant does Roth, their money goes in, but the match dollars go into the traditional bucket. So it's like it is normal dollars. Whereas now, under the new regulation, they're allowing plan sponsors can say you can match Roth dollars so they could build their Roth account faster. And to the
Is,
company,
is that an optional or is that a,
yeah, it's
and that's optional as, I guess this is back to how soon you guys would be able to make the change to be able to handle that. We talking a couple of years out or a year or?
by Friday.
Yeah, by Friday.
I mean, Bishop's on a plane today, so between now and Friday.
I think that one's about a year out.
Yeah, that's what I'm hearing.
But you're seeing that. I think you'll see more. You're going to see more Roth options, and you'll want to, if those are adopted by the plan, we'll want to certainly be communicating them.
Sounds like you have a plan, Kim. Yeah.
Well, I think about this probably a lot more than most at this point in my life, but again, that is one of the things that I've seen in my own situation is that you put too much into a 401k and it builds and builds and builds, which is what you want. And of course, when I came along, that was emphasized.
Yeah.
You didn't really hear much about the Roth back then.
Yeah.
But
Roth they've been
now,
about for a long time.
to control the amount that comes out,
Yep.
you need some Roth in addition to your 401k so that you can control that to a certain extent.
Yep, for sure. So we'll go through those provisions, and there's quite a bit in the new legislation that gives you more options to have your Roth, to build your Roth side. So, okay.
I think maybe as far as goals go for 2023, I mean, it's hard to beat a participation rate above 99%. So I think really what we'll focus on is now starting to touch base with employees who aren't taking advantage of the full match, giving education to employees who are above the age of 55. We've got 3 retirement readiness sessions for those employees. One that's just here in the county, one that we try to do specifically for the county, and then another one in the third quarter sometime, like I said. And so I think just really hitting the groups that aren't taking full advantage of the plan. We'll try to come up with ways to reach out to them. And then of course, the law enforcement that's also one of the campaigns we'll make sure to hit this year.
I have one question. We're on auto enroll, right?
Correct.
Do they auto enroll at the 6 point whatever to get the
6.2.
match?
Yep.
That's where we start them.
Yes,
So
and
they
then
have to opt out of that if they want.
they have to go in and change it. And some do. Some go in and change it to 0. I know. Makes no sense. But, that's their right. And we have a very small fraction of employees that have 0 for their contribution.
Yeah, I just wanted a reminder because I thought that's where we were. But
Well, Voya's got the ability to pull reports for people that are participating from anything below 6.2. Some people are putting in 4%. They don't realize that they're not getting the full match.
I think Kim's just saying he'll add it to his. So take the 6.2
yeah,
and just
could
add it to
that
his.
happen?
And
make it Roth.
Yeah.
Yeah, that's right. I'm willing to pay the taxes on it.
Well, they got to pay the taxes.
Uh-huh.
Even better.
Yeah. Wow, you're throwing out lots of good ideas. It'd probably throw me in prison, but
We'll have education for you there when you're there.
Yeah, that's right. I think that's just a good reminder that we already do auto enroll, so this change is not going to affect us that much. But it's just educating those that I guess
Yeah.
go to 0. Hey, do you really want to do that? Because you're giving money away.
Okay. Well, we'll have, I think that covers all of our agenda items. We've got a number of follow-up items, so like we normally do, we'll pull those all together and send them for review and then make sure
Great.
that we're following on them.
All right.
Jeremy, one of those, make sure if today wasn't fiduciary training and we didn't scare you away yet, we'll make sure we spend some time with you.
Yeah, we're going to, set up a call, me, you, and Jeremy. We'll get some things figured out. So, okay. I want to end this meeting and go into close. What's the best way to do that, Rob?
Motion.
Yeah.
So it's still part of the same meeting. It's just we're going to
Just
go
move
to
into
closed
closed session.
session. Correct. So if you're ready for a motion,
Yes.
move that we set a date and time and location for a closed meeting to discuss professional competence of an individuals at this date, this place, and at this time.
I'll second.
Okay. All in favor, say aye.
Aye.
Okay. We're moving into closed session. So, Soltis and Voya can excuse.